What's up everybody, Emery here with BOA, and this is, as promised, the video series describing to you guys how BOA works, how to interpret the emails, and what some of these random statistical words mean. So before I get started, let me just throw in a quick disclaimer as usual. This is not to be considered as financial advice. Anything you do with your money, you should definitely talk to a licensed professional financial advisor first, and everything I present here is just for informational purposes, like the email itself. And if you want a full disclaimer, it's at the bottom of every email. Alright, now that that's out the way, let's dive right in. So if you're on the email list, then you will have gotten one of these at some point. If you're not, go to cryptoboa.io and you can sign up for free. You're going to get an email in your inbox at around 7 p.m. every day. And the reason it's 7 p.m. is because a new candle forms in cryptocurrency markets at 7 p.m. Eastern Standard Time, which, if you're not on the East Coast, obviously that's going to be a different time for you. But just as a quick example, here's a daily chart, and it is currently 5:38. So in about 2 hours, this candle will finish and a new candle will form. So that's why it's 7 p.m. every day, and the report is going to look something like this. It's going to say BOA report at the top, and then it's going to have a list of coins running down, and each one of the coins is going to have a little analysis under it. Now, the coins might not always be the same. In the future, we have been known to add some coins. It was Bitcoin, Litecoin, and Ethereum in the beginning. Now there's either Classic, Lisk, Dash, Navcoin, and that's usually at the discretion of the BOA team. And if you really want a specific coin to be analyzed, you can let us know, and we'll consider it. And each one of those coins will then have a little sentence under it, or a few sentences, some bullet points. So you'll see in the beginning there's a little TLDR section, which is if you want to skip everything and you just want one quick and dirty thing, it's going to give you a prediction, and it's going to give you a number next to it. And that number is essentially a level of confidence. Basically, if you bought this coin today and you got out tomorrow at 7 p.m., and you did that 100 times, how much money would you have? If you'd started at $100, the prediction was you would have $169. For Ethereum, the number was much higher, so 547. So you can essentially consider that as confidence, and that's calculated based on whatever the chances that the price will go up and what the chances that the price will go down, and whatever BOA calculates will be the average price move up. So, for example, for Ethereum on this day, BOA predicted that there's a 53% chance it'll go up, and if it does go up, it'll go up almost 7%. There's a 46% chance it'll go down, and if it goes down, it's going to go down about 4%. So since it's going to go up even more than it's going to go down, and it's more likely to go up than it is to go down, that's why the confidence was so high. Now I just want to stop here for just a second to stress that you should not be using BOA just by itself. So you shouldn't just pull up the email and be like, oh, Ethereum's a good buy, and just buy it. If the market's been bearish, those are things that you need to take into consideration. The way you want to use BOA is primarily for these three, and we'll get into what they mean in detail in just a second. But you want to use it as a confluence of other factors. So if you have, for example, a specific trading strategy based on technicals, I don't know, let's say it's something like a moving average crossover or whatever, something very simple. You can use that, and you can use BOA to confirm your suspicion. So BOA is going to go back through the entirety of price history for a coin and just analyze how has it behaved in the past, and it's going to spit out some basic predictions. And yeah, so that's how you basically read the basic email. That's how you read the BOA email. You have the coin, you have confidence right here, buy or sell, and I'm probably going to reword this to bullish or bearish in the future because I think buy and sell are too extreme, too like set in stone, because it's more of a suggestion for the coin. And then you'll have here an analysis of the likelihood it's going to go up or down. And it's just based on very simple statistical processes. So after that, you're going to have some of the more gritty statistical detail right here: stationarity, randomness, and independence. And those are three statistical properties that we need to monitor for anything that we want to trade. Let me just get this out of the way right now. If this ever says not stationary, or the TLDR says not stationary, do not trade that coin. Stationarity is a measure of how predictable something is, or how consistent it is. Not necessarily predictable, that's dependence, but how consistent the behavior of a financial instrument is. So if it says not stationary, if this sigma is greater than the chi-squared, and I'll get into that detail in another video. But if that says not stationary, do not trade this coin. Even if it's shooting up, don't trade it. You can invest in it So if something is non-stationary but you believe in the technology, you can invest in it and let it sit. But you will not be able to time your entries and exits without stationarity. That is an absolute necessity. So you have stationarity, randomness, and dependence, and I want to make a video on explaining each of these in a way that makes it easier for people that might not have a statistical background. But before I do that, I want to just go into what chi-square is, because that's going to be important for all the three of these. So super quick recap before I go into chi-square. You got the coin, you have a basic sentiment calculated just on the statistics that you don't want to use by itself, but you want to use it in confluence with other factors. And there's a possibility that in the future, BOA will include some fundamentals and some cycle analysis. So what you see here, my personal trading strategy includes what's called cycle analysis. So you sort of measure cycles and troughs and peaks, and that might be incorporated in BOA in the future. But again, you want more confluence than divergence. You want factors all agreeing with each other. If the fundamentals are strong, and your moving average crossover says it's a buy, and BOA says it's a buy, that is going to be a really good indication that you might want to buy that coin today. Okay, and yeah, so you're going to have that. You're going to have stationarity, randomness, and independence, and I'm going to talk about each one of those in its own video. And then you're just going to have a basic conclusion of the analysis. What are the odds it's going to go up or down, and how likely is it? How high is it going to go when it goes up, or if it goes up, and how low is it going to go if it goes down? And the format of this email is going to change. I'm currently working on redesigning the email, and we want that to look a little prettier for you guys, so it's easier to, because right now it's just a list. But of course, we wanted the functionality to work first before we got into prettying it up. But that's coming really soon. And before I waste any more time, I'm going to dive into what chi-squared is. So chi-squared basically works like this. If we have, let's say there was only 4 days of Bitcoin price values. Let's say for the last 4 days, Bitcoin price had been $7, and then it was $8, and then it was $7, and then it was $8 again, right? Let's say this was all it was. Obviously, we have more data with BOA, but let's assume that this was the case. What a chi-square test will basically do is you take some value and another value. So for example, for stationarity, you generally compare the first half to the second half, for example. So this right here is how BOA behaved in the first 50%, or Bitcoin behaved in the first 50% of its existence. So for half of the time it's existed, it was $7 and then it was $8. And then for the second half of its existence, it did the same thing again. So a chi-square would basically calculate how likely is it that that one certain event is similar to another event. And I'm really kind of stretching the definition of chi-square here because I know most people aren't really into statistics. And if you want to know more about it, you can go on Wikipedia and Google that stuff for sure. But we're basically going to measure what's the difference between one set of information and another. So if we want to say Bitcoin is predictable and the price has been 7 and 8, then maybe we want to see how likely is it that it's going to be 7 and 8 again. So a basic chi-square is just going to take the first value right here and this and the first value of the other, and it's basically just going to divide them, and then whatever the result is, it's going to square it. So that's 0 squared, which is 0. And it would do the same thing for the second value. So 8 minus 8, and square that. And then, as you can see, the chi-square value would be 0. So if I go back to the email, you can see that each one of these coins actually has a chi-square value, for example, stationarity, right? So if the chi-square sigma is 5.65, and then for Monero it was 2.97, Monero was a bit more consistent, or as expected, as Stellar was in this case. And you can use chi-square for anything. You don't just use it for measuring consistency. You could say, I don't know, let's say the average height of males is 5'10" in some country. And then in another country, the average height is 5'7". So you would just take 5'10" and 5'7", and obviously this would be in like inches in that case. And you would basically subtract the expected from the actual, and then whatever your result was, 3 inches, you would square that. And then the value would be 9. So as you can see, the chi-square is basically just going to help you see how big is the difference between two sets of data. And we use chi-square to sort of measure, I think the specific official sentence is, what are the odds that a certain result is due to chance? So if we go back to stationarity, for example, if we say that Monero is stationary and the chi-square value is 2.97, and the critical value, this would be the threshold where we say, whoa, something's wrong, is 24.32, then the odds that it's stationary just completely by chance are really low. It's probably stationary for real because we have so much data and the difference is so low that we can probably assume that it's very that this has not occurred by chance. So with stationarity, we're always going to look for the value to be lower than the critical value. The critical value is just your threshold. So if you have a chi-squared, whatever that number is, it's sort of like a spectrum. So let's say this was your little critical value here, then this would be stationary. This would be a little more stationary right here. And then this would barely be stationary, and at this point we basically consider it not to be stationary anymore. It's a threshold. So the lower that number is, the more stationary we consider value. And again, I'll explain what stationarity is in a second, or in the next video. For randomness, it's the same thing. The lower this number is, the more random the behavior is. And I'll explain what randomness is in another video. Now, with independence, this is the one where we actually want the number to be above. Because dependence basically means today's price is impacted by yesterday's price. If something's dependent, then today's price can be predicted from yesterday's price with a certain certainty. It's not crazy, obviously. I mean, look at these odds, 53% to 46%, but it is an edge, right? So we want this number to be as high as possible because we want it to be as dependent as possible. So that's basically what chi-squared means. And even if that didn't make complete sense to you, just know that chi-squared is just going to measure the intensity of this certain characteristic. So as a quick conclusion, I'm going to wrap it up here, and hope to see you in the next video for sure. But as a quick conclusion, you're going to get an email, and there's going to be an analysis for every coin in the BOA portfolio. It's going to give you a basic sentiment. And the things that you really want to pay attention to, though, are stationarity, randomness, and dependence. You always want that coin to be stationary, random, and dependent. You don't want it to be not stationary. That means we don't trade it. You don't want it to be independent. That means you can't predict it. You can't trade it. And again, if you can't trade it, you can still invest in it. But this is specifically for making trading decisions or entries if you're trying to time the market. And then at the bottom, it's just going to give you a breakdown of the specific odds and the specific moves. So in the next videos, I'm going to talk about exactly what stationarity, randomness, and independence are, and I definitely hope to see you guys there. As I said, if you're not a member of the BOA family yet, you can just go to cryptoboa.io, and the link's going to be below, and you can sign up for the free beta. And things are looking like we're probably not going to put a paywall in front of it anyway. No promises or anything, but you can definitely try it out for sure. We're growing every day, and pretty excited to keep making content for you guys.